Welcome back. Still tuned into Halftime Report on CNBC-TV18. Suprajit Engineering is the next company on our radar. The stock has underperformed in the last 1 year, down around 24%. But what is the outlook for 2023? What about the supply side issues? What about raw material prices as well? Ajith Kumar Rai, the founder and chairman at the company, is joining us now to discuss the same. Mr. Rai, good afternoon. Thank you so much for joining us here and wishing you and everyone at the company a very happy new year. I was looking at the recent mid-year review that you just put out on exchanges as well, and you did speak about how, yes, raw material prices and chip shortage issues coming down, but still it continues to remain a concern for the industry and the company as well. Can you tell us how has Q3 panned out so far? How much have raw material prices fallen from the peak? And is that enough for you to see an improvement in margins as well?
Good afternoon, and thank you for having me on your channel, and Happy New Year to you as well as to your viewers. Yes, the material costs have come down, particularly, the core materials like steel, plastics, etc. have come down. But as you know, we have a clear understanding with the OEMs where, when there's a price increase, we are able to get the price increases. At the same time, when there is a price reduction, they also expect us to pass it back on. So it's a two-way process. So the price impact gets sort of neutralized in the process. In terms of shortage of materials, I think things have stabilized, at least for our range of components that we buy from our suppliers, whereas the core requirement of our OEM customers, like the chips, as you mentioned, it is still an issue. So we have seen that despite some improvement in the chip shortages, most of the OEMs are still struggling to get a very good and streamlined supply of these components. That has had its effects in their production, which in turn affects our production as well. So in terms of the margin profile, I think we have been on our core business stable at around 14% EBITDA margin. We expect that margin profile to continue to be strong and safe. We have been able to pass on where needed. And wherever we have been able to improve on our own internal costing, we have been able to do that. So we continue to expect to do the same numbers in terms of what we have done in the past 2 quarters or past few years in terms of margins.
Right. Mr. Rai, thank you so much for joining in. Just wanted to understand on two of your verticals. One is the light duty cable business and the second one is the Phoenix Lamps division. You said that both of them are seeing some restructuring which may impact their margins in the near term. Can you quantify, what kind of impacts can we see on their margins respectively over the next couple of quarters? And thereafter, you believe that this business will be extremely strong for both revenue and margins. So at a steady state, what kind of revenue run rate and margins can you do?
Let me first talk about light duty cable business, which is a recent acquisition which came to our fold from 1st of April. In our business update, we have said that in the first 2-3 quarters there will be negative EBITDA because of the significant restructuring and cleaning up of the balance sheet that we are doing. The first quarter we had a minus 5% EBITDA margin, and in the second quarter we had the minus, I think, 1.5% EBITDA margin. So the progress on LDC is in line with what we have said in the beginning of this year. So we expect to have a much better Q3 as well going forward. In terms of the numbers there, we have projected between, I think, 85 and 90 million for the current year, financial year, I mean. And for the next financial year, we have, projected a $100 million plus US dollar business from LDC. In terms of PLD, yes, the margins have come down from the past double digit. It had come down to about 3-4%. And in the last business update that we have given, we have said that the bottoming out of the process of low margin is over, and that we will be improving our margin going forward. I think in the Q3 numbers, when it comes out in the next month or so, you will see that there has been an improvement in margins. And in terms of business, it continues to clock strong sales. We continue to have a growth in the PLD division quite nicely. The aftermarket business has been very strong, and so is our OEM as well as our export.
Okay, so that is about those two segments. I wanted to speak to you about the new focus that you have, that is Suprajit Technology Center. recently in November you did see commercialization of a facility there. Can you tell us what is the initial utilization here, revenue potential, since it is also focusing on electric vehicles? What kind of opportunity is it here? What kind of margins are you making? You said initially it could be lower, but in next few years it will go higher. So what is the peak margin potential that you have here?
Yeah, I think Suprajit Technology Center, STC as we call it, and the electronics division, which is the outcome of the products that we have developed at STC, have been doing extremely well. It's a new business that we have started. It is a new direction that Suprajit is taking. I would say it's a new chapter for us going forward. So it's a long-term investment that we are making in this business. In terms of the products, I think the initial products that we have been commercializing is digital clusters, some of the actuators, as well as the throttle grips, electronic throttle grips. These are the products for which we have got some very interesting and exciting new businesses. They're just launched, as you know, only in November that we inaugurated the plant. The production is just ramping up. I think it will take at least another 6 to 9 months, 6 to 1 year, before we come to some reasonable level of capacity utilization. So at this moment, it is at a low volume. But what is interesting is that the new business that we have got are for the long-term, businesses with reasonable volume. So in the next 2-3 years' time, this division will stand on its own foot and be a profitable center for us.
Right. Mr. Rai, then if you could give us some more color on that, because I'm reading a brokerage note which says that the digital instrument clusters, etc., that you currently supply are, content ranging anywhere between 600 to 2,000 rupees per vehicle. Going forward, you can increase this. If you can, tell us how much is the potential here of increasing this, and when you say it will be a business which will stand on its own, what would it mean for the numbers of the business in terms of revenue and margins? Because I believe that from a long-term standpoint, this could be much more margin accretive.
Yes, from a long-term perspective, you are right. It's probably a good margin profile it has got. Let me give a little bit color. I think one of the things that we have said a couple of years ago, that going forward, the content per two-wheeler, which is where the focus of our electronic division currently is, content per two-wheeler would increase over the next 3 to 5 years' time. That is our focus and that's our business strategy. So you are right. I think a electronic digital cluster, anywhere between 600 to 2,500 rupees a cluster, whereas the entire content of cables in a two-wheeler is maybe 200 bucks or 250 rupees. So the intent of us is to increase that content per vehicle, and we are going in the right direction with some of these new businesses. In terms of the volume of business, it is a little difficult to extrapolate next 2-3 years mark numbers. But I think in about 6 months' time, we'll be able to get a clear picture. Okay. What could be the size of the business that we are going to get in this new segment that we have done.
Okay, Mr. Rai, last question before we let you go. In your domestic business, a new facility for after-market cable operation is progressing as per plan according to your release and is expected to be completed by the end of FY23 and will start contributing to revenues from FY24. Considering that, and also that this EV, electric vehicle focused plant will start commercializing properly in next 1 year, what would FY24 revenues and margins look like for you?
No, we don't give an exact number as per our own internal guidelines. What we have always said is that we will outperform Indian automotive industry by at least 5 to 10%. And I think that's what we will do. In fact, as of first 6 months, our growth has been nearly, I think, 23-24% against the industry growth of whatever, I don't know, about 15% or 18%. So we have completely outbeaten that. And in terms of margin, we've always said that we'll be around 14%, 14 to 16%, without the LDC, of course, business, the new business. I think that margin guidance also holds good as of now.
But just because you spoke about growing faster than the market, just an update on your market share. Two-wheelers is 75%, four-wheelers is 32%. Has there been any change? And you have a target in terms of...
Around, I think... Yeah, these numbers are probably reasonably accurate, plus minus a couple of percentage points. But yes, I think we have strong position in both the markets. But I don't think it has changed anything in the last at least quarter or so. It is just that the content of each vehicle probably are improving in our favor, so that the content per vehicle is probably improved.
Okay. All right, Mr. Rai, thank you so much for joining us and giving us all those details. Wishing you a good 2023 as well. That's the word coming in from Suprajit Engineering. For now, we'll slip into a break and we'll get you more news and updates on the other side. Stay tuned.